Ladies and gentlemen, please welcome Jay Mintzmyer, Head of Research of Value Investors Edge. Jay is a renowned maritime shipping analyst who directs the Value Investors Edge research platform on Seeking Alpha. He is a frequent speaker at industry conferences, is regularly quoted in trade journals, and hosts a popular podcast featuring shipping industry executives. Mr. Mintzmyer also hosts regular virtual investor forums, which are a must-attend for anyone interested in the shipping and infrastructure industries. Jay, thanks so much for joining us today.
Absolutely, and thank you so much for that great intro. And it's good to be back here with the Money Show. We did a great presentation with you all in August, and we're glad to come back and update everybody. So as we begin, just a quick overview. I'm on Twitter at Mintzmyer. If anybody wants to follow there, we have about 7,000 to 8,000 followers, and I'll put out maybe once a day or twice a day, not too frequently, but some shipping market updates and the stuff we focus on. We also have free trials available for our research service, Value Investors Edge. You can see the address there, mintzmyer.com. There'll be a 2-week research free trial available, no obligation to you. You can see some of our earnings season coverage, see our positioning into 2021 as we roll out that in the next few weeks, and educate yourself a little bit more about the shipping sector. So today's topic will be post-COVID-19 rotation, overviewing the outsized recovery potential in maritime shipping. Today, we're going to talk about our research background, what we do at Value Investors Edge, and the value that we add to the markets. We'll talk about the COVID-19 impact to shipping stocks and what that's done throughout this year. And then we'll pivot forward a little bit and look at recovery trades and the investment opportunities across 5 subsegments of shipping. And then if we have time at the end, hopefully we'll have about 10 to 15 minutes for Q&A. Feel free to submit your questions into the chat service, and Chantel will filter those through to me. So first of all, Value Investors Edge, our research service. We profit and outperform in the markets over time by focusing on small cap stocks that don't have a lot of institutional coverage. We stay away from the big names, Goldman Sachs, Tesla, Exxon. We focus really on the small companies, specifically in the maritime shipping sector. James Catlin's our lead macro analyst. He keeps us grounded in terms of commodities and the trade flows there. And then Michael Boyd is our energy and income specialist. He talks about the energy verticals in terms of export infrastructure, pipelines, and that sort of thing. In 2019, here's an example of the outperformance we were able to bring to the market. You can see the blue chart there is the speculative model portfolio that we build. You can think of these almost like ETFs. We rebalance them once a quarter, so they're quite stable. These aren't super actively managed or schizophrenic in any way. It's very stable sort of ETF models. That's our speculative account in the blue, and the risk reward profile in the green. It was 101% return in speculative and a 43% return in risk reward, which heavily outperformed both the shipping industry, which is in the purple chart there, and the Russell 2000 itself in the black. So very strong year for 2019. So when things are working well for us, for the sector, and markets are upbeat and positive, like we think they're starting to turn again, we can produce a lot of profit in this type of market. Now let's look at 2020. So COVID-19 has decimated the markets, but we've seen a lot of recovery in names, especially like technology-focused names, as there's a bit of a counter rotation into tech and those sort of defensive stocks. Shipping stocks have been absolutely destroyed. And I presented here in the Money Show in August, I mentioned that only 2 out of 55 stocks in the sector were positive year to date. As of yesterday, 1 December, only 4 out of the 55 stocks ever are positive year to date. So the sector has been completely beaten down in terms of stock prices and hasn't yet benefited from a major recovery or rotation trade, even as the vaccine news comes out, even as folks start getting more and more optimistic. So these stock valuations remain almost at record lows. And surprisingly, and we'll dive into that a little bit as I get into the sector analysis, but the rates, the underlying earnings in most of these shipping segments have actually been quite strong in 2020. So there's a little bit of a dislocation here where folks think, well, I don't want to buy a shipping stock during a pandemic. That's a dumb idea. And that makes sense in common sense. But once you look at what the pandemic has done in terms of disrupting supply and adding a little bit of demand in different segments of the market, like energy transportation, 2020 was actually a quite good year for most of our companies. It just hasn't shown up in the stock prices yet. So in this chart, you can see the 2020 sector performance. You can see the shipping index. So that blue line at the bottom is the overall industry. That's not our model portfolios, that's the industry itself. And you can see that it's the line in the middle of the chart is $50 out of 100 on the index. The shipping stocks were down 50% in the first quarter of the year. If you fast forward to August, which is the last time I updated on the Money Show, you can see that the NASDAQ recovered very nicely through August, 43% gain. The Russell brought it up 37%. Shipping was flat. Shipping did not recover at all. It still sat at those quarter one lows. Nobody wanted to buy shipping between April and August. Now we go to September, November. So a couple months there, 3 months, you can see shipping outperformed both of the other segments. Shipping was up 18%, the Russell's up 16%, and the NASDAQ was roughly flat, only up about 4%. And we think that that rotation trade will accelerate going forward and that the shipping stocks will basically inverse, if not more so, what we saw in quarter one. We expect shipping stocks will be the place to be in the coming 6 months to 1 year. This is our model portfolio performance to date, transparent about our results. 2020 has been a tough year for us, absolutely. Our top risk reward profile is down about 9%. Our speculatives are down about 27% as of yesterday. Of course, remember, the industry is down 55%. So we are massively dominating the industry, about a 20% alpha in terms of what we comp ourselves to in the shipping index industry. So why did these stocks lag? Well, first of all, terrible screen to go into 2020, to go into COVID. They're value stocks mostly, low price to earnings, low price to book, low enterprise value to EBITDA. So value did not go well. Small cap stocks, nobody wanted to own these during potential global shakeup, pandemic, maybe a recession. Nobody wanted small caps. Nobody wanted international exposure. Commodities were shunned. Higher leverage companies were disliked. And of course, China exposure to cap it all off. So very, very bad, broad screen for 2020 for shipping stocks. Also, most of the shipping investors that we work with are deep value oriented. Deep value folks are very skeptical, right? They've been worried about putting money into this market. Most deep value folks pulled all their money out in February and March and ran far, far away. And so those are the kind of folks that usually buy shipping stocks. So that has also not helped the supply and demand of the shares itself. There's also been a challenging history of returns and governance in the shipping sector. I've been here for more than 10 years, and I can tell you there's been massive improvement over the last 10 years. Back in 2010, it was the Wild West of sorts. Things are a lot better now, and all the companies that we'll discuss today in terms of our top picks all have solid corporate governance, and I know the management teams quite well, but that is something to consider in terms of the overall industry. So why is this changing now, and why do I believe this is going to improve going forward? Well, first of all, the value investors are going to come back to the markets. Once we get a more clear pathway to a vaccine and a global recovery into 21, we're going to see these value investors come back, and they're going to snap up these shares that trade at all-time record lows. They're going to look at more of the fundamentals, a little bit less of momentum in the stock price, and a little bit more of the fundamentals of supply and demand in each sector. We're also going to see very strong cash flows across almost every company we'll talk about today. And those cash flows, once we're past COVID, those companies are going to be more comfortable with returning dividends and loading into repurchases. In fact, there's several companies there, I list 6 of them in my slide, that have actually already started very large repurchase programs. And also, if we get a lot more stimulus, a lot more government spending, we might see a return of inflation trades to have some prominence there. We've already seen this with crypto. Bitcoin, of course, set an all-time high just a couple of days ago. It's flirting around 20,000 right now. Gold and silver, gold is kind of making a comeback. Shipping is one of the best places to be if you believe in heavy inflation. All the rates and vessel valuations rise with inflation. Debts, of course, fixed debts reduce in value with inflation. Think about like if you own a house, the value of that debt comes down if there's lots of inflation. And so we could see potential astronomical net asset value and earnings per share gains. So I'm not necessarily a huge believer in massive inflation myself, but for the folks who are, shipping is a sector that does make sense to position into. So broadly speaking, we're going to talk today about rotation trade. And when I say rotation, I mean the sort of moving away from the technology stocks, which have been super popular this year, and moving back away from the stocks with 200 times price to earnings, 15 times price to sales, very, very rosy outlooks, and moving back into some of the unloved sectors will actually benefit from a sustained global recovery. So we're going to talk about 5 subsegments of the shipping sector: the container ships, LPG and LNG gas trades, crude tankers, and the dry bulk markets. So starting with container ships, this is a clear bet on a global recovery that continues and it stays fairly steadily. Container ship rates, they bottomed out in May, but since then we've seen 6 straight months of rate increases. The average container ship rates right now are at 12-year record highs. And that's hard to believe that we're seeing 12-year record highs during the midst of a pandemic, but you got to think about what everyone's doing right now. Everyone's buying things from Amazon, from Walmart for delivery. They're buying a lot of new appliances for their house. They're spending a lot more time in their home offices. They're buying a lot more furniture and stuff like that. Well, all that stuff that you think about that comes from Amazon, most of it comes from China. Most of it comes in containerized boxes. So the containerized trade has actually held on quite well. And if you go to Home Depot or Walmart or a lot of these stores, you'll see a lot of the stores are actually quite low on inventory, quite low on stocks. So there's a big restocking season going on right now, which strongly benefits the container trade. The forward supply of container ships is quite low. The order book is under 10%, which is the smallest it's been in almost 20 years. And there has been, not so much right now, but there was a lot of demolition of some of the excess tonnage in the past few years. So our overall top pick in containers, this company we believe is the most solid, the largest cap to look at is Costamare, stock symbol CMRE. Some of the other companies to consider: Capital Partners, CPLP, Danaos, DAC, Global Ship Lease, GSL, and Navios Containers, NMCI. And disclosure, as we go through most of these companies, please be advised I do my own research and investing as well. So I do have a long position in the majority of the companies we'll be talking about today. So keep in mind, I run a research book. I work with clients. We're basically talking our book throughout most of this presentation. So the container ship sector is an oligopoly market. Basically, just about 5 liners control 2/3 of the market. So there's a lot of pricing control here. And we saw that during COVID. When the demand dropped off in May and into June, there was a lot of blank sailing, a lot of canceled voyages, which helped keep prices high. Well, once we got to about September, October, the demand roared back, and now there's no canceled voyages. Now there's actually China and European regulators are pressuring the container companies to bring even more ships into the market because the supply is so tight and the rates are the highest they've been in 12 years. They don't have any more ships to bring. So every ship that's available is being put to work, and that's why we're seeing these rates surge. This is a 1-year chart. You hear a lot of folks talking about the V-shaped recovery, and we haven't seen it in many segments, but here it is right there for you. In fact, it's more of a check mark. It's just a beautiful chart there with the 1-year container rates. Here's a 10-year chart. And if you look back to about 2016, which is about midway in the chart here, right around here, you'll see the bottoming of that long-term cycle in the container ship markets. We had a steady recovery through 2019. A lot of these stocks had started to recover as well. And then we saw that dip here with COVID. We saw the little dip here and then a massive recovery. We're actually now at 12-year highs. So again, our top pick was Costamare, CMRE. I've had recent talks with management. We talked a little bit in the intro that I host a podcast series. We call it Value Investors Edge Live. During November, we hosted 20 top maritime firms on our service for an interview and chat with our members. And we talked with Greg Zikos, their CFO. I've known him for over 8 years at this point. Solid management team, very focused on long-term returns. Costamare has a solid balance sheet, no near-term maturities, and a very healthy balance between the long-term charters, which is kind of the underpinning of a leasing business, but they also have near-term spot exposure, which means that as the rolls happen during Q3 and Q4 next year, we'll start to see larger and larger getting reported. They trade 34% below their 50, and in fact, that was yesterday's price. So I think it's actually a little bit lower today, even though they have the best prospects in a decade. So clear disconnect in this name. For LPG, think about like propane, liquefied petroleum gas. So this is a very unappreciated market, very niche sector. In fact, there's only one US listed stock here. So Dorian LPG, stock symbol LPG, is the only real player in the game on the US markets. These rates have been soaring for 5 months straight. COVID had no impact. In fact, COVID's had a positive impact in a weird way because Indian consumers, India is the #1 consumer of imported LPG, have been staying at home more, right? Doing a lot more home cooking, home heating. Well, they use propane very heavily for this. So the overall yearly consumption has actually increased in India and China as well. So a normal market is about 25 to 30,000 a day to rent one of these ships. The latest print a couple days ago was 80,000. I think it was 75 today. So very, very strong prints, way off market. Those sorts of levels, not 75 to 80, are not sustainable. However, as we pull up the rate chart, we'll see that we've had 50s and 60s over the last several years. So very strong market. So our top pick is Dorian, and that's really the only US stock there. This is a recent chart of the rates. It goes back to about 2016. So you can see through 2016 to early 19, late 18, we were in a long-term cyclical trough. These are cyclical stocks. So you tend to see that. You tend to see a couple of years of weakness and 2 to 3 to 4 years of strength, followed by a few years of weakness. So we're probably about midway through the bull parts of the cycle at this point. You can see the big dip here with COVID, rapid recovery. It was really only a dip for about a month. And then since then, the rates have just went on astronomically. Dorian LPG, again, is our top pick. Strong balance sheet, no near-term maturities. They will have over $4 in share per share of cash, even though they only trade in the tens. They only have 30% leverage, so quite low leverage as well. They have an active repurchase program, very open management. We talked to them several times in the last few months. And they also trade 35% below the 52-week high, even though best rates, best prospects we've seen in 5 years. LNG, a related segment, so liquefied natural gas. So we had very optimistic prospects in 18 and 19. A lot of folks were talking about LNG export facilities and whatnot. But then we had two very, very warm winters in Asia due to the El Nino pattern. And also COVID-19, of course, which caused some temporary disruptions. The LNG shipping markets, they're poised to grow 10 to 15% annually for the next 5 to 10 years. We had a disruption in 2020 because of COVID and a couple of warm winters in Asia, but we're looking at a very cold winter this year. It's the La Nina effect, which is supposed to be hitting through January or February of 2021, as well as the return to some normalcy in Asia. They're not quite struggling as much as we are in terms of COVID numbers and slowdowns. So also we have the seasonality, which is going on right now and helping a lot of these companies with their cash earnings. Our top pick in LNG is Flex LNG. They are backed by one of the largest ship owners in the world, John Fredriksen out of Norway, a very powerful, strong backer, good corporate governance, and a very accessible and transparent management team. Other firms, Gaslog, Golar, and TK LNG Partners. So the US is driving this LNG trade. The US didn't really start exporting LNG until about 2016. The export growths are projected to grow year over year to at least the mid 2020s, maybe even 2030s. US is the largest source of future export growth in the world, as long as they keep going with their export facilities and projects. We're likely to be the second largest global exporter by the mid 2020s. COVID slowed that down a little bit, but if you think, maybe instead of 24, 25, it's now 25, 26, we're still on track for that. And potentially, this may be a little more controversial statement, potentially could be the largest exporter in the world if we look out maybe 15 years or so. If you look at this chart here, you can see that up until about 2016, 2017, the LNG exports were negligible. And then you see a very steady, very strong ramp from 2017 up to 2020, followed by, you see here, this dip for COVID, which is now starting to rapidly recover. This data from the EIA trails by about 2 months. So we're actually closer to about where my mouse cursor is right now. So we're almost fully recovered. I expect by January or February of next year, we will have fully recovered and be back onto a growth trajectory. The markets are very seasonal, and you can see every winter there's a strong surge in rates. The tighter the market, like the more healthy the supply and demand of vessels is, the higher this peak. So you can see in 18, the market was probably normal-ish, whereas in 19, the market was quite strong. It's a good, healthy balance. Again, pretty healthy last year. It just didn't last very long. And again, pretty healthy this year. We're not sure how long it's going to last. It's based on primarily on weather patterns, because Asia primarily uses natural gas for heating. So the colder the winter in China and Korea, the more imports we'll see. The forecast, according to both Japanese meteorologists and Australian meteorologists, is for a La Nina winter, which means things are going to be quite cold, which means this chart could definitely accelerate up and hold for a few months. So again, our top LNG pick is Flex LNG. And again, recent talks with the management, we actually just hosted their CEO on our interview series about a week and a half ago. Very strong balance sheet, no maturities until 24, 120 million in free cash. They just launched a repurchase program. They reinstated their dividend, and the company trades 33% below the 52-week high. So everything is going right for this company except for the stock price. Folks are not interested. So for crude tankers, the final segment we're going to cover a very long-term positive supply setup. Crude tankers were very interesting this year because of the initial oil price war. And I'm not sure how many listeners here today remember, but oil prices actually went negative for a little bit. This led to a huge spike in offshore floating storage, which helped all these tanker companies benefit. They made a lot of money in a very short amount of time, and now we're kind of in the hangover phase of the market. So we earned 3 years of cash flow in about 2 to 3 quarters. So 2020 was an amazing year as a crude tanker investor. For the stocks, not so much. Folks are worried about the next 6 months, 9 months of earnings. They're very rapidly discounting the cash flow that's already been earned. They only care about the future. That makes sense for stocks to care about the future in terms of long-term future, but apparently they only care about the next 6 months or 8 months. The next 6 to 8 months are going to be challenging. There's no sugarcoating that, but we have to remember all these companies have strong balance sheets, and they just earned 3 years worth of cash flow in about 3 quarters. In the longer term, there's a very low supply growth. There's not a lot of ships on the order book, and a lot of the global fleet is rapidly aging. So not only are these older ships going to be demolished, going to be scrapped because they're too old to function in the market, we're also unlikely to see a lot of new ordering because there's so much regulatory uncertainty. We're not even sure what the next propulsion fuel is going to be. Is it going to be ammonia? Is it going to be hydrogen? Is it going to be some sort of LNG hybrid? We actually don't know this yet, so a lot of the owners are too cautious to order new vessels. So supply is going to be very tight for the next few years, while at the same time, the global demand prospects are still on track. We kind of took a pause in 2020 with COVID, but we expect 21 is going to look a lot like 2019, and then we're going to resume a small growth, not significant, but 1 to 2% annual growth. The key here is that the annual growth pretty much all comes from Asia. So India, China, Korea, those are Indonesia, Pakistan, those are kind of your growth markets, whereas almost all the future supply is coming out of Brazil, Nigeria, US Gulf. So we're seeing this huge kind of west to east transport market, which takes 2 to 3 times the shipping capacity as it does from the Middle East Gulf to India to China. So when you see these things about OPEC cuts and export reductions, that's negative for the near-term tankers, but it's actually quite bullish for the longer-term picture because it means more oil is going to be sourced from places like Brazil and the US Gulf. So our top pick in crude tankers, very large cap, very strong management, is Euronav. Some other firms to look at, DHT Holdings, Diamond S, International Seaways, and TK Tankers. Just some overview slides kind of talking about what I'd overviewed before, but here is the large tanker fleet. You can see that each quarter here, starting with Q2 20 and working up, these are the number of ships that have to enter special dry docks and special surveys. These are very expensive, and when rates are poor, these dry docks and surveys can spur demolition because the owner says it's not worth it. I'm not going to spend this extra money. I'm going to end up demolishing and scrapping this vessel. So we can see right here, we're in the middle of Q4. As we go through Q1, Q2, Q3, and Q4 of next year, we expect that a decent degree of this tonnage will end up being scrapped. This is what I talked about with the west to east movements. You can see most of the growth is actually coming out of the China and India side of the world, whereas most of the export growth is coming out of the Brazil and US Gulf area. And you can see that illustrated on this chart, Euronav put a great one together. I'm kind of stealing it from them. You can see that it takes almost double the shipping capacity to move stuff from west of the Suezmax, or west of the Suez Canal here in the Atlantic Basin over to China as it does from the Middle East. So the shifting export mix is very bullish for longer term tanker investors. Again, our top tanker pick is Euronav. Rock solid balance sheet, leverage is less than 30%. They pay out 80% of their earnings. It's a very transparent policy, and they trade 40% below their 52-week high. So again, another company is very heavily beat up. Finally, dry bulk. This is a clear bet on Chinese stimulus. If you believe that China is going to spend a lot of money getting their economy back on track, you want to be involved in the dry bulk market. The number one player here is the iron ore segment, which is ran between Australia and Brazil. If you've seen the headlines recently, China and Australia are not getting along very well. That means China is going to rely more and more on Brazil. Well, guess what? Brazil is 3 times further away than Australia in terms of shipping tonnage. So that means that every ton of iron ore that China pulls from Brazil instead of Australia leads to a tripling of the voyage length. So if you expect that Australia and China are going to continue having a lot of tension, and you expect that Vale from Brazil is going to fill that gap and export a lot of iron ore, then you absolutely want to be investing in dry bulk. There's not a lot of supply growth coming for 2021. So if demand goes up, rates are going to skyrocket. Our top pick in dry bulk by far is Star Bulk Carriers, stock symbol SBLK. They have the strongest management team, the best corporate governance, and they still trade at a discount. Some other firms to look at, Diana Shipping, Genco, Golden Ocean, and Navios Partners. Again, our top pick is Starbulk. We've, again, communicated with management. We hosted them about 3 weeks ago for a live discussion with our members. Very strong balance sheet, no maturities, strong liquidity. Their entire fleet is equipped with scrubbers, which enables them to meet the regulations for IMO 2020. We also believe they're going to be able to meet the upcoming 2023 regulations with no additional upgrades required, which puts them in a stronger position than some of their peers. They are 32% below the 52-week high, despite everything we talked about, despite all the favorable trade in terms of iron ore, and despite the light at the end of the tunnel in terms of COVID-19. So a recap of these trade investment themes: containerships, global recovery continues. You definitely want to be looking at Costa Mare and its peers. The LPG, if you're liking that cash flow machine, liking the strong prospects of India and China consuming more propane, you definitely want to look into Dorian LPG. LNG, if you like the long term, we're talking 10 to 15 years of growth, plus a little bit of a seasonal trade bonus, look into Flex LNG. For the crude tankers, that long-term supply setup, this is anywhere from about 1.5 years to a 3 to 4 year time frame. So I guess a medium-term investment, look into Euronav. And then in dry bulk, if you're betting on that Chinese stimulus and recovery, look into Star Bulk Carriers. So ran over a little bit there, but we still got about 5 minutes for questions. Again, if you want to follow us, we're on Twitter at Mintzmyer, and then a 2-week research free trial is available. No obligation at all. You can sign up in a few minutes. Mintzmyer.com. You can access our earnings reviews, latest segment updates, and all the rest of our exclusive content. So thank you again, everybody, for the presentation part, and we'll turn it over to a few minutes of questions.
Great, Jay. Thank you so much. There are some questions for you, that's for sure. Here's the start. What's a reasonable EV/EBITDA multiple for pure play container shipping companies to trade at?
Yeah, I think that's a great question. It allows you to comp the EV to EBITDA. It allows you to comp them to, say, pipelines or other sorts of infrastructure investments. For container ships, it really depends on the length of the backlog. If we're talking about a backlog with 5 years of signed charters, 10 years of signed charters, then you can crank that multiple a little bit higher because there's a little bit more stability involved. I would accept a multiple of maybe 8x or 8.5x on something with a long-term backlog. If we're talking about a spot market player, then we also got to look at what's their leverage, what's their earnings potential, what's their near-term cash flow. So if you're talking about near-term spot, that question becomes a little bit more difficult. If you're talking about a long-term backlog play, then definitely 8 to 8.5 is probably reasonable. Near-term, I'd probably say closer to probably mid-5s, mid-6s. But again, I'd also look at their cash flows, their debt maturities, their liquidity. So I hope that helps a little bit, but it's a very complex number to look at.
Okay, great. Thank you. Is there an investment opportunity in buying shipping containers and leasing them to shipping companies, and any sense of return levels?
Yeah, that's another great question. So there's box lessors. They're the ones that own the 20-foot or 40-foot metal boxes. There's 3 very highly traded liquid public companies that do that: CAI, Textainer, and Triton. TRTN, Triton's the main one. Those companies already trade at basically 100% adjusted book value. So not only book value, but also adjusted for the recent surge. We think that trade was a great idea if you were into it 6 months or 9 months ago. The ship's kind of sailed on that one. So forgive the pun, but the ship sailed. If you want to make good returns in the sector, you want to be buying the ships themselves, not the boxes.
Okay, thank you. And according to the Straits Times, China has blacklisted more than 50 ships with Australian coal, leaving them stranded. How has this affected some of the shipping stocks?
Yeah, that's a good question. So the coal side of that trade is a short-term headwind. So it took a little bit of supply off the market, which you might think is a little bit of a help. But at the same time, we're talking about replacing that Australian coal with Indonesian coal. Now, Indonesia is closer than Australia. So in shipping, we want things to be as far away as possible. However, the coal and iron ore trades are very closely linked. So if China starts to replace some of their coal with Indonesia, they're also going to have to replace the iron ore with Brazil. The impact of switching from Australia to Brazil is far more impactful than any sort of coal trade. So in terms of pros to cons, it's like taking away 1 and adding 3 in terms of a bullish picture. So we're very, I don't like lots of global tensions and stuff like that. But in terms of things that could be optimistic for dry bulk, Australia-China tensions are very, very bullish for us.
Okay, thank you. And can you comment on the massive Bass Straits LNG complex and the China trade natural gas trade potential?
I'm sorry, I missed the first part of that question.
Can you comment on the massive Bass Straits LNG complex?
In terms of that complex, exactly, I don't have a specific additional comment to add, except that we are watching all the project developments, and I'm very happy to see that there was a new export complex that was green lighted basically last week. It was one that had been put on pause for a couple of years. We're really looking towards the United States to be the main source of export growth. There's a lot of both greenfield and brownfield projects that we're looking at into 22 and 23. Tellurian's Driftwood would be one of the ones towards the higher end of that list that I would encourage folks to look at. We had a COVID delay, but we think things will be back on track by mid-21.
Great. Now, the International Maritime Organization recently mandated cleaner burning fuel for shippers. Are there enough suppliers of cleaner burning fuel to support these new standards?
Yeah, we were very concerned about that as we started to enter 2020. The regulation itself, IMO 2020, moving away from the high sulfur content. So we primarily wanted to position ourselves in firms that either had high scrubber uptake. Scrubbers mean you can burn the older, dirtier fuel because the engine scrubber will clean it out and make you compliant. So we tried to invest ourselves in firms that either had a higher percentage of those or were mixed, so at least they were hedged somewhat. It turned out to not really be a big problem. The shipping industry got sort of bailed out, if you will, by the fact that COVID knocked out jet fuel demand. Jet fuel is like a kerosene. It's a cleaner form of diesel. So the big drop in jet fuel allowed time for the refineries to rebalance for that regulation. So by the time COVID works itself out by say Q1, Q2 of next year, we don't expect there's going to be significant supply problems.
Okay, and then let's end on this thought. What is your overall top conviction idea in the shipping sector, and share any risk factors or cautions for investors in this sector as well?
Yeah, absolutely. I especially like asking about risk because I think it's important for folks to go in with both eyes. So in terms of the top idea, Dorian LPG, by far, stock symbol LPG is our top conviction idea. This company trades at less than 50% of its tangible book value. So if they just took all their ships and sold them on the market and returned the cash to shareholders, we'd be looking at like $21 or $22 a share. If you look up LPG right now, I haven't seen it in the last hour or so, but it trades in like the mid to upper tens. They have right now $4 in cash per share. We expect them to have $5 to $6 in cash per share by like early Q1 of next year, so January, February. They have an active share repurchase program. Their leverage is no problem. It's less than 30%. So by far, top conviction idea is Dorian LPG. I think a lot of folks they associate that with a tanker firm, and they don't quite understand that LPG is completely separate than oil. So again, Dorian LPG, stock symbol LPG, can't miss it. In terms of risk factors, you really want to look at balance sheet maturities. You want to look at what's coming up in the next year to two. You want to look at the liquidity available, so the cash and revolvers that are available to handle those maturities. Most of the problems in shipping occur from when a company comes up on a debt maturity, they have no cash and the rates are bad and the banks don't want to help them out. That's when you see these massive equity dilutions or bankruptcies or those sorts of things. The second risk factor is management. So make sure that you have strong corporate governance. Make sure you're sticking to some of these quality US listed names. And again, all the names you listed today in our top picks, they all have solid corporate governance and a management team that's very transparent and open.
Fantastic, Jay. Thanks so much for joining us today.